Would you like to learn how to get a £6 million house for just £200,000? That and many other things to do with the financial markets, the future, are covered in this week's edition of Money Matters. We're coming up to that time of year where I do my annual, very, very useful, very, very famous predictions for next year. So make sure you don't miss out on my 2022 predictions, which are going to be coming out between Christmas and New Year. Okay, to Money Matters. Hello there and welcome to this week's edition of Money Matters, because as you know, I believe money matters. What I want to cover in this week's edition is three things. First, I want to talk about the interest rate rise that's coming that's going to cause the housing market to crash. Second is first-time buyers. And third is just a little bit about how the mortgage market actually works. Because what I want to share with you is a brand new product from Kensington Mortgages. Now with Kensington Mortgages, this really is a first for the UK. You can now get a mortgage for 40 years and it's fixed. So if you're terrified about the thought of mortgage rates going up, reflect on the fact that with Kensington you can get a rate for the next 40 years from as low as 3.34%, which is really pretty low. Now, okay, this isn't an investment product, this is a residential mortgage product, so it's not for buy-to-lets before you go running off with that idea. It's for buyers or first-time buyers. But the loan-to-values can be as high as 95% for a first-time buyer and still get the 40-year fix, or 85% for a remortgage. So I want to look at that in a second in the context of, what if you're considering buying a property and you are a potential first-time buyer. But before I do that, I just want to retreat to this kind of first point that I said about, crazy interest rate rises. Well, just think about, do you think that the financial sector, the banks, believe there's going to be a big interest rate rise anytime soon? Well, no, because if they did, then this type of product simply wouldn't be available. Because the very fact that there is a 40-year fixed, and okay, it's residential, not buy-to-let, and you can fix those rates from as low as 3.34%, which historically is very low if you look at the last 50 years. It means the financial sector believes that for the next 40 years, 3.34% return on their money will be good. Okay, so that's part one. We'll come back to that in part three at the end. So let's just now focus on you as a potential first-time buyer. Why should you consider buying a house? How would it work? What would it mean? And how much money would you have to come up with? That sort of stuff. I'm always asked, should I use my pot of money to become a homeowner? Or should I use my pot of money to buy a buy-to-let and I'll carry on renting? And I think that's a fascinating and a great question. And I come down firmly on the side of use your pot of money to go and buy a home to live in. All sorts of reasons, but briefly they are. Number one, when your house increases in value, so they call it capital value appreciation, when it goes up in value, if you live in it, that gain is tax-free when you sell it. There is no other tax-free vehicle similar to that. You can't get any sort of tax-free benefits similar to that by investing in a buy-to-let. Second, if you don't buy a property, then you're going to end up renting, aren't you? And your rent is going to be more than your mortgage. Third, you can do things like rent a room allowance. So, if you're at that stage of your life, whether you're sharing with your best mate, or you've got some other people sharing a room, you rent together or something, well, you can use rent a room allowance. So let's say, and people here at Touchstone at work have done this, they've bought a house or a flat, they've then rented out their spare room to one of their mates for £400 or £500, which was their share of the £1,000 that they were renting together on. And that £500 more than pays the mortgage, so effectively your mate is now buying the house for you. And under rent a room allowance, it's all tax-free. Regardless of your income tax position, you can earn £7,500 through rent a room allowance. The government is encouraging you to take in lodgers. So even if you're even a 45% taxpayer, that's still tax-free. So you can have £7,500 tax-free. The rent is going to be more than the mortgage. You get tax-free capital appreciation. And the killer for me as a property investor is it is so much easier to get an investment mortgage, a buy-to-let mortgage, if you are a homeowner. So I'm a big advocate of you becoming a homeowner, which is why, all my kids are and many people here in the team are as well. But I want to look in particular at, let's say you went to Kensington and you took a 95% mortgage on a £200,000 house. How much money would you actually personally have to come up with? Well, imagining it was a £200,000 house or flat, 95% loan to value means that they would give you a loan for 95%, a mortgage for 95% of the 200k, which just happens to be £190,000. Obviously, 95% of 100 is 95, 95 times 2 is 190. So you personally would have to come up with 10 grand from somewhere. Would you have to pay any stamp duty? No, because as a first-time buyer, you're going to be below that threshold. Would there be any other costs? Yes. So you'd maybe have to allow, for instance, £1,000 for your legal fees. But that will pretty much be it. So in order to buy that property for £200,000, you need £11,000, possibly £12,000 of your own money if you were going to use this 95%. Now, to keep the numbers simple, keep them as simple as I can, I'm going to cheat a little bit, and I'm going to say that the mortgage is 200,000, so you've just gone and bought a house for 211 or something. So I want to do the numbers with you. Now, your mortgage payment then is going to be a fixed amount for the next 40 years. So it's not going to go up. But your salary is almost certainly going to go up, isn't it? Now let me put this in context for you. I happen to have been a property investor for 39 years now. So again, can I cheat a little bit and pretend it's 40 instead of 39, and then that's consistent with this 40-year mortgage? I hope that makes sense so far. I bought my first flat, 2698 Roman Road, East Ham, London, for £9,000. That same flat today is worth more than £250,000. So let's say you bought and you got the same sort of increase over the same period, the same 40 years. Something you bought today for £200,000, or 211, whatever I said, but just call it 200 for the sake of an easy number. I bought mine for 9, let's call it 10 for the sake of an easy number. It's now worth £250,000, let's call it 300,000 for the sake of an easy number. So it was gone up in value by a factor of 30 times over 40 years. So if your £200,000 house went up by a factor of 30 over the next 40 years, well, 200,000 times 3 is 600,000, so times 30 is 6 million. Imagine how sick you would be to the stomach if a house that you could have purchased today for 200,000 pounds and you didn't do it is worth 6 million in 40 years' time. You'd look like a bit of a spanner, wouldn't you? In my view. And I'm just giving you the last 40 years of my experience. So get on it and do it. Be the best investment you probably ever make. But how much would your mortgage actually be? Because when I took out, when I bought my first houses 30, 40 years ago, people were like, oh, you're going to go bankrupt, the mortgage payments, whatever. Well, just be real, everybody, be real. So if I wind you back to the early 1980s, the average adult salary then was around about £11,000–12,000, and look at where it is now in London. It's way over 30 grand. It's multiple times that amount. But your mortgage interest payments will move. So even I'm going to use again an easy mortgage interest rate to calculate 5%. Well, 5% of 200,000 is 10 grand a year, which is about 800 quid a month of interest. Now you've got to add your capital payment to that as well, so it'd be a bit more than that. But 800 quid now, you might think, oh, it's a bit stretchy, but it will be less, like for what you could rent a house for. Why? Well, because a landlord like me will go and buy it, put a mortgage on it, add a margin to that, a profit for me, and then rent it to you. So the rent is always going to be higher than the mortgage, and I hope that makes sense. So you will be saving money because you've got a mortgage instead of rent. That's number one. Number two, you can do the rent a room thing that I talked about. Number three, imagine that £200,000 property is worth 6 million in 40 years' time. You don't want to be a spanner, do you? So get on board. Okay, so hope that helps, and I hope that's useful to all my first-time buyer viewers out there, or people considering buying their first property. Why is it that I believe this is such a strong signal from the markets that long-term interest rates are not going to be particularly high? I could see a world in which interest rates are 3-4%, perhaps even touching 5% for a period. The structure of our national debt is such that the government can't really allow interest rates to go much higher than that. Otherwise, they themselves can't afford to repay the debt on the national debt. Okay, so we're kind of capped and collared in terms of what a realistic expectation of future mortgage rates is. So I'm really talking to experienced property investors now. Now, my view on insurance is you should insure something that is going to be terminal to your business. It'll take you out of the game, it'll be critical. And if it isn't going to take you out of the game and it isn't going to be critical, don't insure it. Where are you going with this one, Paul? Well, insurance companies, on average, make money, don't they? So, when you go into one of them electrical retailers and you buy, I don't know, a tumble dryer for 300 quid or something. And then what they try and do is they try and sell you insurance for like 70, 80 quid or something in case it breaks down. And it's probably quite a big percentage of the purchase price. Now they do that because they make virtually no money on selling you the tumble dryer, and they make all their money on selling you the insurance. So the average payout on that 70, 80, 90 pound insurance, they're probably collecting a 50% commission for selling you that. So on average, I know that something like a tumble dryer, if it needs to be fixed, it needs to be fixed, but on average it won't. And on average, if I give them £90, I'm probably wasting £40 or £50. Does that make sense, everybody? Now, in exactly the same logic, if I fix my mortgage payments for the next X years, I'm essentially paying an insurance premium. Okay, so if I have to get my tumble dryer fixed, that ain't going to clean me out financially. I can afford 100 quid for a new tumble dryer motor. Okay, so it isn't going to wipe me out. Equally, because I've got lots of properties, an interest rate rise isn't going to wipe me out either. So here's the news. Whenever you pay a fixed mortgage, you're actually paying an insurance premium in case it goes up. On average, the variable rate should be less than the fixed rate if the clever people that do the numbers at the banks have got their numbers straight. So it's like buying an insurance. So if an increase in the mortgage rate would take you out of the game, get your house repossessed, whatever, take the fixed rate. If it won't, probably stay on the variable rate. I hope that makes sense. And this obviously is just general guidance. It's not specific advice for any one person. But on average, the longer you fix for, the more insurance you're paying. So if you can afford to take the risk, consider staying on the variable rate, even though that fixed rate might look quite attractive. Okay, so I hope you've enjoyed this week's edition of Money Matters, 40-year fixed rates. I really never thought I would ever see that in the UK. Get on the property market ladder, get on the housing ladder if you're not already on it, and learn more about the ins and outs of how interest rates and banks and financial markets work. Just make sure you don't miss another edition of Money Matters. Click, subscribe, like, tell all your mates. Hope you've enjoyed it. You've been wonderful. I've been Paul. See you next time.